Hello Sector Watchers, welcome to the show. This is the 190th episode of Sector Spotlight for Monday the 28th of August. My name is Julius the Kempenaer and I am presenting to you from Amsterdam in the Netherlands. We're approaching the end of the month of August, and that means that we are going to take a look at seasonality. So this show will be totally dedicated to the seasonal patterns that we see in the various sectors, and we'll try to see if we can find any alignment with the actual rotations as they are appearing on the relative rotation graphs. Ladies and gentlemen, this is Sector Spotlight. So here's the table with the seasonal figures that we usually use here in Sector Spotlight, and when you've seen the show more often you will be familiar with this table. I've recently, a couple of months ago, started to subdivide this group in the three groups within the sector, so offensive, defensive and sensitive, to maybe even get a better handle on seasonality for a group as a whole. Let's start with the S&P 500 itself. So for SPY, everything is looking at outperformance, so relative performance. For the S&P 500, we're looking at price performance. We're looking at absolute performance because comparing SPY to SPY doesn't make much sense. If we look at the figures for the month of September, that's the month that we're going into, we see that 60% of the time the S&P 500 ended the month higher than it opened. So that is mildly positive. However, when we look at the average performance over the last 20 years, that's just the straightforward average performance for the month of September, that is a loss of 40 basis points. And when we combine 60% of the months gaining and an average performance of minus 40 basis points, what it actually means is that in the 40% of the months that the S&P 500 ended lower, that these losses were actually way bigger than the gains that were made in September. So all in all, the month of September is not the best month for the stock market. We all know the saying, sell in May and go away, but remember to come back in September. And by the looks of it, it means that you probably should be coming back towards the end of September, because the month itself is not fantastic. But if we do a little sneak peek ahead, then we can see that October and especially November and December are actually very good months for the stock market with stellar returns, I have to say. And remind you, these are averages, so they could be way bigger than that. Now on to the performance of the various sectors. If we start with the group of offensive, then that is not fantastic. Materials 40%, financials 55%, real estate 40%. And the only one that's, well, it's 60 and 40 is the same, because if you're outperforming 40%, you're underperforming 60%. So it's very, very average, very across the middle of the road, basically. And if we look at the average returns, then the only one that really stands out is materials with a negative return of 80 basis points, combined with a 40% outperformance, so 60% underperformance. We can take a look at the chart in a minute, but I'm not super impressed with these numbers. Take a look at the group of defensives. What stands out is utilities in a negative way, so 35% of the months in outperformance. That means that 65% of the time it's underperforming. And if we look at the average performance, it's about zero. It's in line with the market. So in line with the market's down minus 0.40. So, you know, you could expect utilities to go down 40 bips. Well, I mean, it's all very much a toss of a coin. 35 is kind of okay, but the 0% is not fantastic. And then staples and healthcare, 55 and 50%, not very impressive either. And 0.3% and 0.1% outperformance, not fantastic. The only takeaway that I would get from this is that Inside the group of defensives, you better avoid utilities because that's very likely to underperform, and the performance will be in line with the market, whereas staples and healthcare may squeeze out a little positive, and then staples, but it's like, as I said, 50-55%, not super impressive. And then if we go to the group of sensitive sectors, the story continues. 53, 55, 45, that's all very much right in the middle. The only one that really stands out is the industrial sector with a 70% outperformance over the S&P 500. And if we look at the average performance of the month, it's 40 basis points for the industrial sector. So looking at the constellation and the expectations based on this seasonal picture, I want to take, there's not much to be said, unfortunately. So there's not a lot of takeaways that we can get from here. The only things that we really need to look at is industrials, obviously 70% combined with a 40 bips outperformance, and probably here utilities with 35%, so 65% underperformance and 0% return. And we may take a look at the materials sector, but that's merely because of the minus 80 basis points average return over the last 20 years. I'll prepare the charts and let's take a look at those individual charts and what they can tell us in combination with the relative rotation graphs. Okay, let's take a look at the individual tails of a few of those sectors that we just discussed based on their seasonal metrics, their seasonal expectations. And this is the group of offensive sectors, and really there's materials was at 40% outperformance, so 60% underperformance, and consumer discretionary was at 60% outperformance. Both not fantastic. I'd like to see 65 or higher or 35 or lower to make it at least worth looking at the graph. But in this case, what triggers me is for the materials sector is the average underperformance is 80 basis points under the S&P 500. So with an expected return of the S&P 500 of 40 basis points lower, minus 0.4%, materials expecting 80 basis points, that means that materials sector as a whole could be going over 1% lower in price terms in the coming month. That's kind of what that says. The significance in terms of how many months over the last 20 years that has happened is not great, but the expected return is worth looking at. And if we look at this price graph here, and I'm going to bring so here's the tail, I'm going to bring the price graph next to it, and we can combine what we see here. Now, if we look at the tail here, then you can see that the RRG velocity, that's the distance between the two nodes, is getting smaller and smaller. And very often that is a sign, or at least it makes the turn for the tail a lot easier. And I have compared it before with a chain with shackles. The bigger the shackles are, the more difficult it is to create an arc in the chain. You need a lot of big shackles to make that tail. It takes a lot of shackles to make that arc. If the shackles are a lot smaller, you can actually make a very quick and small turn. That's what this is. That's suggesting. So given that seasonal pattern, given that expected negative return, we have to take into account that it's possible that the materials sector is actually inside improving and rolling over and starting to move lower. And we all know that is a very negative rotation because it means that we will get in a new down leg in an already relative downtrend. And if we look at the price chart, I think we can relate to that. It's inside a trading range. We touched the upside, the upper boundary of that range. We didn't really quite make it. I see that I could actually have drawn this trend line a little bit further, and then we had a few more touch points, but it's significant enough. And you see that we dropped back below, and we're kind of on a way down here. And if you look at the relative strength line, that sort of completed a small double top here, and the RS momentum line is already rolling over. That's what you see here on that tail, with the RS ratio line way below the 100 level. So out of this group, I think the most important takeaway is that the materials sector is definitely on a path for underperformance, and despite the fact that the significance of the number, it's only 60% of the time that it's underperforming, the expected underperformance in terms of average underperformance with 80 basis points makes it potentially worth a trade in terms of underperforming the S&P 500. We move to the group of offensive sectors. Then, just to remind you, this is defensive sectors. The utilities outperforming only 35% of the time, 65% underperforming. Staples outperforming 55%, healthcare outperforming 50% of the time, and the average returns 0, 0.3, 0.1. So that is bang in the middle. There is no no significance whatsoever in terms of outperformance or underperformance. The only thing that stands out is the 35% for utilities, meaning that 65% of the time this sector is underperforming the S&P 500, but the underperformance is absolutely minimal with 0%. So bringing that information to this graph here and bringing in the price chart of the utility sector, I'm going to try to make some sort of a case here. It's a bearish case because utilities are on the left-hand side. They're the lowest reading in this group. They're picking up a bit of momentum, but they're also still moving to the left, albeit marginally, but they are moving to the left. It means that they're losing relative strength, or they're going lower on the RS ratio scale. So it's definitely not a good sector. And if I look at the price chart here, then we can see that this area where we're currently hovering, and that's just above 63 US dollars. It's a very strong horizontal support level. But what's more intriguing is the major lower highs coming in. So that is a negative because it means that there is still price pressure, and the selling pressure is coming in at lower levels each time. And that's pushing that relative strength line lower. So here is still very clearly a downtrend in play. And you can see that the only reason why that RS momentum is picking up, because the pace of that decline is slowing down. It's still going lower, but the pace of the decline is going slower. That ticks up that RS momentum line, and that's ticking up that tail upwards into the improving quadrant. But it's definitely not an uptrend yet. So combine that with the weak seasonal expectations. The main takeaway for this group of defensive sectors is probably that utilities is the worst of this group. Now, try to make that into a positive thing. All these sensitive sectors are on the left-hand side. They're all in underperformance. They're all underperforming the S&P 500. You can see that very nicely when I sort this group here on the percentage change over the last 10 weeks. You can see that the S&P is the strongest. All are underperforming, with utilities leading it's leading the negative leaderboard. Does that make sense? I don't know. Still, minus 2.2, where the S&P is up 2. So the good thing is that when very defensive sectors are underperforming, that is usually a good sign for the market. So with the weak month of July that we have had behind us, or almost having had behind us, we could be looking at a stronger month of September, and that's what we're seeing, albeit probably towards the end of the month, because the chart's not looking fantastic yet. But be prepared. The weakness in the defensive sectors could lead to more positive signs for the S&P 500 going forward. If we look at the daily tails here, you can see the weakness of the defensive sectors very clearly there, and you can see how utilities is inside the improving quadrant, rolling over with the shorter RRG velocity, the shorter distances between the nodes. If we see a price decline of utilities, let's say below 63 US dollars, or if you want to be really sure, this low here is 62.60, I think that could be a sign for an acceleration lower in the utility sector. And then finally, the group of economically sensitive sectors, that was the group which has the industrial sector in it. It's a bit ironic because the industrial sector is I need to make this into a weekly, by the way. The industrial sector, it has the highest reading, 70% of the time it's outperforming the S&P 500 in the month of September. But when we look at the tail here, this is probably the weakest tail of this entire group. Communication services is slowly starting to curl back up. Technology is still moving lower, but it's inside weakening and higher reading, so the uptrend's still there. It's still going through that corrective mode. Energy is doing really, really well. And then you see industrials did very well, but is now already starting to roll over. So it's got a negative RRG heading already, or not positive. It's outside. It's over 90 degrees, which is not strong. And in that way, it's entering the leading quadrant at I would say, a weak footing. So despite the fact that 70% of the time industrials is outperforming the S&P 500, I really doubt whether that's going to be the case for this year's September. The other months, communication services was at 53%, energy is at 55%, and technology is at 45%. So there's not much significance coming from those three. And if you look at the average returns, that's 0% for communication services, 30 bips for energy, and 10 bips for technology, which is pretty much in line with the market. So no real significance there. And yeah, for industrials, I am very reluctant to make a bullish case for the industrial sector with this kind of tail. If you look at the price chart that belongs to it, that could help us, because we're still hovering and we're still holding up above that breakout to new all-time highs. It looks as if we've set a new low here, which is right smack on the previous high here. So that old resistance is now respected as support. That is a positive thing, but we really need some short-term signs for industrials to pick up again and to move higher. If we look at the daily chart for this group here, then you can see how industrials is actually still weakening a little bit. You see how it's moving there. It's very, very marginal, very, very marginal. And in combination with those seasonal numbers, we definitely need a little bit. If it's going to happen in the month of September, then we definitely need a little bit more time. It's not right now the time to pick that up. So I'd be looking for some short-term buying signals on the price chart in combination with a turn back up in terms of relative strength. So when you see the daily tail of the industrial sector starting to pick up and move into a positive RRG heading, doesn't really matter where it is on the RRG graph. As soon as you see that tail starting to point in a heading between 0 and 90 degrees, that's probably a good time to start adding to the industrial sector. And then it gets back in line with the seasonal expectations as we've seen it on that table. So wrapping it all up, it looks as if the best takeaways from these seasonal patterns are a more bearish approach for the materials sector going forward into the month of September, bouncing off that resistance, heading lower. Another bearish approach for the utility sector going into the month of September, inside improving, rolling over, potentially breaking below this support area. And then The industrial sector might be a positive takeaway, but only if you can see some short-term strength kicking in and that tail, that daily tail, starting to point in the heading between 0 and 90 degrees. Not the best news, I'm afraid, not the strongest takeaways, but you know, you can't have it all. That's what it is for this month in terms of seasonality. I'm going to leave it here for now, wrapping up this seasonal edition of Sector Spotlight. And hopefully I'm planning to come back later in the week when we have completed monthly bars with the usual segment of monthly bars for all the sectors. And that was it for Sector Spotlight. Thank you for watching, and I hope you enjoyed the show. And please remember, Sector Spotlight is available on demand on the Stock Charts YouTube channel, usually recorded and uploaded on Mondays. And as always, feel free to share your thoughts and ideas in the comments below the video or reach out via any of the handles on the screen. Looking forward to seeing you again at a new episode of Sector Spotlight, same time, same place.